Welcome to the daily update, where I'll go over the action in the market for Tuesday, May 14th, and then we'll see how things look for Wednesday, May 15th. The market just wanted to go up on Tuesday. The PPI came in a lot hotter than expected, and the market could have just tanked on that news. The futures did really gap down, but this was before the market opened. But then they kept coming back, and we fought our way back to being positive, and then later in the day we kept going up, and we closed not at the high but pretty much near the high. And this is what happens when we're in more solid bull markets with good momentum, is the market can use whatever it wants to justify anything. They could have focused on the negative and just went down. They decided to look back at the revised PPI to say, well, they really brought those numbers down from last time, so we're going to be happy about that. That's how the market works. And so we never know from one day to the next what they're going to use to rationalize prices either going up or down. We've got the big CPI report coming out. Now, PPI is important, but CPI is very important. And retail sales, which is a huge part of the US economy, that's also very important. So we'll see if things continue to be positive. We are looking extreme to the upside. We're not quite at a new all-time high for the S&P, but the NASDAQ hit a new all-time high. Some of the Magnificent Seven stocks showing a little bit of an improvement there, which could really drive things higher. Seeing a bit of an improvement with the NASDAQ 100. So for right now, things look positive, but at the same time, somewhat vulnerable. And if you've watched these videos for any length of time, you know that when we're going down, I tend to say, okay, these are some positive things that could happen. When we're going up, okay, these are some negative things that can happen. Not because I want to get in the way of what's already happening, because we see a lot of confirmation in our charts that we're positive right now, but just to be aware of things. Because one of the biggest skills I had to learn to really break through was I would get caught off guard. And that seemed to be what really threw me. So if I just try to see as much information as I can and be prepared for anything that can happen, then you're not caught off guard and you can adjust things. And sometimes you have to react to those things. You can even anticipate some of those things before they happen. Okay, I do have an announcement. I made the first announcement for Tuesday's video. I'm going to keep making this announcement until it actually happens. And here's the information right here. On Monday, June 3rd, I'll be locking down the daily videos. Now, this is only the daily videos. For right now, I'm going to keep the weekly videos, the intermarket analysis video, the deep dive video, and the what to watch videos available. Because my approach is all of the weekly videos, those are like on the outside. Those are just things that we look at to get a bigger picture look at what's going on. The daily video is the real backbone of my analysis and my commentary and the types of strategies that I implement when I get in, when I get out. That comes down to the daily videos. Plus, there's a lot of people that they just can't watch the daily videos and they still find value in the weekly videos. So I want to keep those available. And the daily videos will be available right at the close. So for example, this is for Wednesday. So if this was locked down, it would only be available to members until the market closes. I set a timer on that video and then it goes public right after the close. Because as I mentioned before, I get about half of the people that watch the videos that they watch it after the market closes. And I still want to be able to use this as an educational tool to try to help people. But I also want to use it as a promotional tool at the same time because I'm trying to build the program. Now, if you don't want to be in the program itself, it's $97 a month. And there are some videos on both YouTube and Rumble where I go through the things that are included in the program. But if you say, I don't want any of that other stuff, I just want first access to the daily videos, that will be $19 per month if you're not a member in the whole program. If you are a member, that's included as part of your membership. Now, there's been a few people who've emailed me and wrote comments that this is kind of a hardship for them. What I'm asking those people to do, I did it in the comments and I'm saying it here. Please send me an email. There are some ideas that I have because first and foremost, I'm an educator, but at the same time, this is a for-profit business. And at some point, I need to start generating money from this. And then there's programs off into the future that are going to really benefit the members that I need to really get going so that those other programs can actually get going as well. So if this is something that is like a make or break for you, send me an email. Let's talk about it. Okay. And here's the email. Instead of putting it at the end of the video, here's the email address right here. And that would be the best way. There are things that are going to be between you and I that we talk about that I don't necessarily want to post publicly. I like it to be back and forth between us because every person is a little bit different. But I am willing to work with folks. So let's see what we can do with that. Okay, now I'm trying to get to the next slide here. There we go. So let's go back and talk about what happened, and then I will go through the charts. Right at the open, we did have a higher open. That's after some gyration that occurred before the market opened when PPI came out, and we climbed up to R1 at 52.35, and then we chopped up and down between R1 to the upside. We went down to the daily pivot at 52.23 and the unchanged level. That was to the downside. And it was pretty much, okay, what's going to happen at this point? Are we going to break lower? Well, we ended up turning and going higher. We climbed back above the unchanged level because we had gone negative there for a while. And we got above the daily pivot, which were pretty close to each other, the unchanged level and the daily pivot. We got back up to R1 and we kept climbing up to R2 at 52.49. And then we closed just a little bit below R2. So we were up 0.48%, not a huge percentage move, but it's one of the more active days than what we've seen in a while. However, we're still below average with volume. It might be CPI that could really bring the volume back into the market. We'll have to see. And don't forget retail sales, which is also a big report. That's going to be coming out as well. So the market's going to be trying to juggle both of these pretty much at the same time. We are positive with our technicals. We are overextended to the upside. That part's a fact. Whether that means that we're overextended and we need to pull back, or whether that is showing good momentum, that's the subjective part that we keep seeing. At least to right now, it's showing good momentum. But at some point, we could hit some overhead resistance and turn and start to go down. And right now, it's, as always, it's about inflation and interest rates. But in Wednesday's session, it's going to be even multiplied by a huge factor because of CPI. It was CPI that 2 months ago came in hotter than expected, than a month ago. So the market is really anticipating what will be happening this time. And we want to keep an eye on the different geopolitical events here. Some comments. PPI came in quite hot, but they looked back, and I'll show you the numbers that they were revised from. I usually don't show those, but I will for this one. And those revised numbers, that ended up making the market happy. The NASDAQ did hit a new all-time high, and small caps had a good day, but now they're just getting to the top of the range that they've been in. And then meme mania has returned. You might be hearing about that if you pay attention to things. These are, I actually did a video that you can still find on YouTube. It was back in 2021. It's about my goodness, 2-3 hours. I don't know how long it is. It's a long one, but I use that as a teaching opportunity. I talk about long and short and bid and ask, and because that's when the meme mania was really happening. I don't really pay attention to this because this is outside of the S&P 500, but you might be hearing about this. You might be interested in it. I used it as a teaching opportunity, and you can go back. And I believe, yeah, you can actually see me in that video. I actually used a camera where I'm talking at the same time. So that's something you might want to check out. I don't know if this is an area that interests you or not, but please feel free to do that. And then Fed Chair Powell, who did have a speech. And isn't that interesting? We had PPI coming out, and then right around that time, within an hour and a half, I believe it was later, he was going to be giving a speech. I don't know if there was any front running to this. Now, they know the economic reports way ahead of time, but I don't know how much control he actually has over his own schedule. But during this, not really speech, it was more of a group's talk type of a thing. question panel thing there that they did. He called the data quite mixed. Now, how's that? The person who's supposed to know most of what's going on in the economy is saying, isn't that interesting? We're kind of strong, we're kind of weak, we're mixed. All right. And then Google is introducing some new AI features, and that helped really boost up their stock. This was announced at a conference that they had, and now everybody's all excited about that. On a short-term basis, this list has not changed. We are still extreme positive. Again, you can take that as positive or negative with the Stochc RSI, the Williams percent R, the CCI 14 and 20, the stochastics, and the slope oscillator. This list has not changed. Intermediate term, we do have a new addition where we've had the CMB composite again, which it usually doesn't stay extreme positive or negative for many days. Well, it's the 4th or 5th day now. The TTM squeeze is a new addition to that. That's a momentum oscillator. The Sean trend meter, which has been on the list for the last few sessions. And another new addition is the 10-day moving average of the S&P highs minus the lows. That's getting up to an extreme reading. Now, this chart had stayed extreme positive for most of 2024 until we started to run into trouble in April. Then it really started to go down. Now it's starting to come back up, and that is showing good momentum. And it's not double or capital HI, it should be lowercase I there. Long term, we still have our 150 and 200 period moving averages. And then this scenario, I haven't changed it for right now. We're hoping that there'll be some more clarity. And unfortunately, these things don't often become very clear. The market is usually gray, but it's likely that the Fed's going to leave rates unchanged. And that's what the market is anticipating for right now, the higher for longer idea. And if there are any rate cuts, we don't really know. They're as they look out into 2024, they're not really pricing in much. They can price it in way down the road, but that's probably going to change for right now. And the Fed continues to decrease quantitative tapering. That's where a lot of the thrust is coming from, the upward movement that we've seen. The market really likes that. The dollar was down and interest rates were down. We closed at 4.45% for the 10-year yield, where yesterday we had been at 4.48%. We're still inverted with the yield curves. Sentiment is neutral. It came in at 54 where it had been at 50. So one more tick up and we'll get into positive land. And then with our trend, we're still not trending. The ADX is now trying to turn up, but it has not crossed its moving average and it has not crossed above 20. So we're still in a non-trending environment. Our bias is positive with the update and our momentum continues to be positive. Here's the economic reports. We did get the NFIB small business optimism, and that came in a little stronger than expected at 89.7. They expected 88.9. Last time it was at 88.5. Here's the big one. PPI came in a lot stronger than expected, up 0.5%. They expected it to be up 0.3%. This is what the market grabbed onto. Last time we got a reading of up 0.2%, they revised it down to minus 0.1%. So they didn't really like that. When we look at the core PPI, this could have just completely freaked out the market, but it didn't. It was up 0.5% as well. They expected it to be up 0.2%, so this came in hot. But look, we also got this revised from being up 0.2% to down 0.1%. That's what the market latched onto. Here's some charts. Here's showing the year over year, where we're starting to go back up with the blue line, the total PPI on a year over year basis, and core is also starting to go back up, but the market doesn't seem to care about that for right now. And here's a year over year look at processed versus unprocessed goods. They're both going up, both the blue line and the yellow line. And final demand of goods and services, they're both starting to go back up on a year-over-year basis. Here's our chart showing the 12-month rate of change where PPI is now going back up. And we look at it month-over-month rate of change. That's also going back up. And here's the core. This is what the market really tends to latch onto. You know, you take out food and energy, the things that everybody has to have. This is flattening out, but slightly starting to go back up on a year-over-year basis. It's still declining on a month-over-month basis. And then we have the business optimism index, where it was stronger than the previous reading and showing a bit of an improvement. Then some Isabel net charts, and this is another one similar to what I showed yesterday, but this is measuring something different. These are what are the Dow returns after a 9-day win streak? Well, 1 month later, 3 months later, 6 months later, and a year later. And these green little diamonds here, that just shows you when these things happen and then what happened after that. And we see pretty good returns going forward from here. And then mega cap growth and tech positioning. We had been getting really extreme. The last time I showed this chart, we were getting a little bit lower, not too much different than where we're at right now. But now it's starting to turn back up just a little bit as the market has been bouncing back up. And then the share of equity capitalization relative to GDP. The blue line, this is the US. And this is like astronomical. You can see that we did get this high during the COVID lockdowns, but we're coming back up. The US just has a lot of debt. Now, there's this idea that I'll go through in my supplemental videos for members where I really go in depth about modern monetary theory and the good points and the bad points and the positives and the negatives of that. But that's pretty much what the government is implementing now. And it's not modern. This has been tried many times in history, and it's never worked. But of course, the attitude this time is, well, this time it's different. Yeah, but we're just showing a lot of debt to GDP, and at some point, the U.S. is going to have to deal with that somehow, some way. When you do the rest of the world, they're just at a mere 61% of debt or GDP to market cap. And then strong earnings surprises in the first quarter. We are seeing stronger than expected earnings reports that are coming out. And that's been also last week, because it was kind of slow with economic reports. That was mainly reports driven, but it didn't really bleed over into the market. And we saw a pretty quiet week, but we didn't see a negative week either. Now with all these reports coming out and with earnings tending to surprise on the upside, that's being taken as more positive. And then the yen is tracking interest rate differentials. We've been keeping an eye on the yen. It's still in a long-term downtrend, but it's starting to bounce back up. And this is comparing the 10-year government bond yield, and then we subtract the Japanese yen here, and they just have a tendency to follow each other. I don't follow this really close. I go through this in the intermarket analysis video each weekend. And as I see things during the week, I kind of read them and take notice, but this is just something that we keep an eye on. And then earnings sentiment, where we look at the S&P 500, that's the dark blue line, and this is really going up, and all of the other countries around the world are also seeing an improvement as well. And then bank loan funds, and I think this means that people actually paying back their loans. They don't really give a lot of description with this chart, but this is kind of positive, just meaning that, okay, people borrowed money and they're paying it back. Yeah, that can help the banks. And then a few charts here. This is U.S. core CPI seen as cooling. They do think it's going to come down, at least according to, I think this is a Bloomberg chart. And then the surprise, the economic surprise index, where we're actually coming down when we look at U.S. economic reports. They're coming in weaker than expected. Now, this is going to change because this doesn't include PPI, and we don't know yet what's going to happen with CPI. Where Europe is getting stronger than expected economic reports, even though it has been coming down. And then here's the meme idea, where GameStop and AMC shares soar as meme stocks revival continues. And then this might go on for a while because Kramer came out and said he warns against meme stock mania. He says to sell GameStop and AMC. So they might still have a little more room to go to the upside. And then looking at the month over month for CPI, and these are based on what we get. This is what is anticipated to be the move that will end up happening. And unless we get really strong numbers, it should be to the upside. If we do get strong numbers, it'll probably be to the downside. These are just projections. Nobody knows what's really going to happen. And then this is usually a chart that I show over the weekend. This is from FactSet when I go through the earnings, and they have a couple of blog posts, usually each week. This is just saying that on their earnings calls, those that are citing inflation are really continuing to drop. And then here's also some forecasts. These are the different people that come out. This is where we get our expected economic report data from. They kind of take a median forecast from all these folks from these different banks, and then they come up with this is what the market expected. They're thinking it's going to come in at 0.3, where last time it was up 0.36. Oh, and I should go back. And when you look at the core here, the first, oh, this is the core. That's the one that the market really focuses on. And on an annual basis, that would be 3.6%, where others, the previous month, it was at 3.8%. We don't know what's going to happen there. And it's all over the map, and everybody's got an opinion, and they think this is going to happen. We just have to wait and see what happens and then watch how the market reacts to that. Here's our intraday chart. We're still seeing a lot of kind of flat days overall, and that's why I've extended this chart longer. I usually just show 5 days on here, but I wanted to get this going back a little bit. Where we did have a higher open, we went up to R1, then we chopped back down to the daily pivot and to the unchanged level, and it looked like, well, maybe we're just going to sit here for a while. But later in the day, we got back above R1. We made it up to R2. That was overhead resistance, and closed just a little bit below R2. And not really seeing anything all that drastic here in our intraday chart of the SPY. You can see where we were flat, stayed flat. And then here's when the report came out, and then the market's reaction to it. And it's probably going to be even more dramatic on Wednesday. We're still hanging in there when we look at an intraday chart of large cap growth versus large cap value. The blue line is above the red line. So intraday, that's holding up. The end of day charts, they're not, but we're looking a little better here. And we did see a bit of an improvement here with S&P growth of value on an intraday chart. But on the end of day chart, growth was up more than value. It was up less for the mid caps and up less for the small caps. But our end of day chart, they're not really doing much. They're, in fact, the small cap ratio is still going down, as is the mid cap. And we ticked up just a little bit with the S&P growth to value ratio. And we turn back up just a little bit when we take a growth ETF and a value ETF and we do a ratio of them. But yeah, it's going back up, but we're still inside of the rainbow. And discretionary to staples, kind of blipped up a little bit there, but nothing too strong. Large cap growth was up and coming back. I don't know if it's set an all-time high on the close, but it's not quite back to its intraday high. The Wilshire was also up, and this is a broad market measure and is looking better. When we look at the trend, you can see how the ADX is starting to turn up, but it's not above its moving average, and it's still below 20. So we're in a non-trending environment, but the green line is on top, so we default to positive. We're seeing it turn up a little bit more, but not quite across the moving average yet with our short-term ADX, and the green line is also on top. Volume continues to drop off. We'll see if that can pick up. Here's sentiment. We're still below the moving average with the Ulster Index. We don't have an updated reading from Investors Intelligence where they had been more or less neutral. We ticked down just a little bit with the VIX on the line chart and the bar chart. And we're showing a little bit of an increase still with the volatility of the VIX, where we had been getting very, very low ratings. Well, we've got some major economic reports coming out, so it's probably only stands to reason that the VIX may pick up a bit in volatility. But the momentum of the VIX still continues to be down, even though the MACD is starting to turn back up. We've had 2 up days now with the VIX. The equity put call ratio declined on the daily chart and continues to decline on the 5-day chart. We're starting to turn back up with the volatility risk premium. We're not quite up into this band yet where it had been giving us a very low reading. So this is suggesting volatility is picking up. We're turning down with this fear gauge, and we're just kind of flat to slightly declining with this other fear gauge that we follow. Still looking pretty good here with the advanced decline line, actually coming back and getting a little bit at a new high here, breaking out above this previous high, lagging just a little bit with volume, but it is picking up slightly. We did see a drop off in the new highs, but they continue to be positive. So our 5 period and our 10 period are still going up. We ticked up just a little bit with the advanced decline ratio, but we're still positive since we're above 0. Accumulation distribution did turn up, and that's going above the moving average. That's positive. The Chaikin money flow is also looking positive now. The Chaikin oscillator is also positive. And when we look at the cumulative NYSE advanced decline line, That's really showing some improvement, as well as our regular advanced decline line for the NYSE. The other NYSE advanced decline line, which is calculated a little bit differently, that's also showing some improvement. And when we look at common stock for the advanced decline line on the NYSE, we're breaking out both based on price and volume. So the broad market's actually doing quite well currently. When we look at the cumulative advanced decline line for the S&P based on price, we are breaking out above this previous high. We're coming back up and not quite back to this previous high based on volume. We're still looking pretty good across the board with our advanced decline line studies. Here's the daily chart. We're still above this pivot point, and we're still above the 50-day moving average. We ticked up a little with volume, but we're still well below this blue line, which is the moving average. The RSI is still extreme positive, as is the Williams percent R, the CCI 14, and the CCI 20. Now I have stochastics in the right place, where we are extreme in the short term, intermediate short term, and now the long short term. Looking at our 20-period double and triple exponential moving average, we're above the lines, and the lines are starting to go up. So this is showing some improvement shorter term. We turned up barely with the 20-period, a little bit with the 50, and we're continuing to go up with the 200-period moving average study of the S&P 500. The force index did tick back up and is looking positive. Here's the 20-period moving average, simple and exponential moving averages. They continue to show an improvement. As I said before, with this blue line coming back above the red line, that is turning things a little bit more positive. And we're just on the border. We're barely into the +3 channel with our standard deviations chart. If we go up and get deeper into that, that's when we get extreme positive. Intermediate term, tick back up with the balance of power and continues to be positive. The go, no go is now drawing these light blue bars. That's positive. And we're getting up to the highest high value, and that's going up as well. The TTM squeeze, we're getting up to this black line. I like to say this here. I put this black line on here as a point of reference. It doesn't really mean that we're getting extreme. It's just based on looking at this historically, this is about the point when we start to really notice this. Looking at our 50-period double and triple exponential moving averages, above both lines, they're both going up. It would turn even more positive if the red line could get back and cross above the blue line. Here's the CMB composite, which continues to be extreme positive. 50-period moving average study. Didn't I show that? Okay, well, or was that the 20? Anyway, looking pretty good here. And then the ease of movement is still declining a little bit, but it's above 0. The Erin went up, and that has turned positive for the last few trading sessions. We ticked up with the S&P McClellan oscillator, but we're not extreme. So we're going up with the summation index based on price and volume. We're going up with the NYSE McClellan oscillator. So the NYSE summation index is going up based on price and volume. This is a warning sign. We continue to decline with the Swenlin trading oscillator. However, we have turned back up slightly with the Swenlin trading oscillator based on volume. Now, we're still positive, but the fact that this is going down as we've been going up, that's a warning sign. Momentum still is looking positive with the PMO, and then based on price and volume, they're all going up. We're going up just a little bit with the PMOs above 0, or excuse me, the PMOs that are rising. We're going back up with the buy signals, and we're slightly starting to go higher with the PMOs that are above 0. We switched back over to positive with the Elder's Impulse system, where after Monday, we had switched to neutral. Parabolic SAR is positive, and just to remind you, the weekly chart has turned positive after last week. So we have a daily confirmation and a weekly confirmation. The slope oscillator is still positive and getting above this green line, which may be getting rather extreme. The MACD continues to be positive. All of our oscillators in the short, intermediate, and long term are now positive. And we're above all the moving averages here. The longer we can stay above it, we're seeing these shorter term moving averages slowly start to turn and go back up. The bullish percent index did go up. That's looking positive. And we're going up with the NYSE bullish percent index, and we're also now above 50 and advancing with the NASDAQ 100 bullish percent index. We continue to decline with the money flow, but we're still above 50. And we're ticking back up a little bit with the ultimate oscillator. We're still declining with the green line with the vortex, but it's positive. And we're still looking positive and I should have put this on the list. The RSI based on 9 periods, that's a short-term RSI. It's now starting to get extreme positive, where the 14 period is still just looking positive. Unbalanced volume continues to be positive. We're turning back up with the stocks in the S&P above their 20-period moving averages. So that's looking solid. Here's our study. We're above 70. So we had what could be seen as an upward thrust. Now we wait to see if there's going to be any follow through to that. We're going up with the 50-period moving average study. We're turning back up with the 100 as well as the 200-period moving average study. The Copic curve is positive. The Sean trend meter is positive and in that initial extreme positive land. Here's the Ichimoku cloud. We're starting to break up out of this. And then here's the new study that I'm including where we're looking positive. We're going above the cloud. The blue line is above the red line. And this green line, which is really hard to see here, we should be starting to turn back up with that. But I guess it's right here. So it does lag just a little bit. Standard deviation is coming down slightly, but it's still well above the moving average, showing that we've been going up pretty far, pretty fast. The Pring bottom fisher, we're still working off of that buy signal, and the mass index, which, okay, is this going to be a positive thing or a negative thing? I was looking at the context because what triggered this mass index was when we were going up, we crossed down below the red dashed line, we continue to fall, but we haven't seen a reversal, at least yet. But that could change. And on a trending basis, though, with the Heiken Ashi, we are positive. We're positive with the Kegi, positive with the Renko, positive with the 3-line break. And we had a new X drawn in here with the point and figure chart. Not having a signal generated yet, but we're coming back to this previous all-time high. If we could get above that, that would be quite positive for the market. And then our long-term weekly chart of the S&P, we're still above this R1 level. If we really start screaming down, we're going to be watching this 5110 to 5111 level. We're still looking extreme with the 150 and 200 period moving averages. And this is a newer chart that I got over the weekend from one of the perma bears. We're going back up with this ratio now. When we look at semiconductors versus the Dow, if we could get back up to this line, that would be more positive. If we really see this start to fall, that's going to turn things more negative. Also, the 197-day cycle. Probably after this video, I'm just going to show this in the weekly video from now on because 197 days, that's a long time. But since this is a new chart, we did hit that cycle on Friday's session, and you can go back 197 days, and at least since we dealt with the high set in January 2022, this has done a pretty good job of marking tops and bottoms. So we're just waiting to see if it plays out that way. We're positive across the board with the Keller market model for all the different indexes, and we're still negative with bonds based on price in the intermediate and long term. We're in a short-term downtrend with the dollar, and that's been giving support to stocks as well. No changes here in the decision point scorecard. We saw a lot of blue and then the dollar falling, which actually ended up being positive for stocks. But we see the NASDAQ and we see the industrials having a BPI. Real estate, well, what do you know about this? It crosses above 70. So we're seeing a little bit more improvement there. Here's the one-day chart of the sectors. You had tech, real estate. Wow, 2 days in a row near the top. Financials had a good day. All of the sectors ended up being up except for staples. And that's what we want to see. We want staples to go down and discretionary to go up if our growth to value ratios are going to show some improvement. And we did see the mega caps outperform just a little bit, but we've been really choppy in here. Now you could take this two ways. It's like, okay, maybe the Magnificent 7 or 4 or whatever it's at now, okay, they're not leading like they were before, which really helped the market go higher. That's the negative side. The positive side is, well, it's because we're seeing the rest of the market kicking into gear and giving more support. That could be a positive way to look at this. The Dow was up 1/3%, and we're still above this R1 level. But we still remain neutral with the diamonds when looking at the Elders Impulse system. We finally broke above this R1 level for the NASDAQ, and we did set a new all-time high. So that's a positive thing. We also broke above this R1 level with the NASDAQ 100. These pivot points tend to be pretty important, and the fact that we got above that is positive. Now the question is, can we stay above it? And we switched from being neutral back over to positive with the QQQs with the Elder's Impulse system. The momentum for the NASDAQ 100 is positive. And here's the Qs. We're above all the moving averages. We're starting to see the shorter term moving average turn back up, but we want to see that cross to turn more positive. And here we are at the high end of this range that we've been in with the small caps. Yeah, they had a good day, but we want to see some kind of a breakout. You can see there's kind of different points of resistance here. We really want to see this continue to go up if we're going to turn more positive. But we are positive with the Elder's Impulse system for the small caps. When we look at the Russell 2000 small caps, looking pretty good from the chart. We're setting a series of higher highs and lower lows, higher highs and higher lows. That I always get that mixed up. We're above 50 and going up with the RSI. The longer term trend is positive. The shorter term momentum is positive. Mid caps, we're able to get above this R1 level. So they're showing some strength right now. And they've turned back over to positive after being neutral for the Elder's Impulse system. When looking at the mid caps, Apple was up a little over 0.5% and is above its 200-day moving average, but it's still in a longer-term downtrend. Tesla was up over 3% and trying to get back above its 50-day moving average, also still in a downtrend. We're still a little bit above the 50-period moving average when we look at NVIDIA, so that's still holding up. Microsoft is trying to break out above its 50-day moving average, and it's in an uptrend. And Meta was up 0.82%, but still below its 50-day moving average, but it's still in a longer-term uptrend. Amazon, after going back and setting at least a new intraday all-time high, it's been dropping back down, but it was up slightly on Tuesday. Google, which continues to climb here, it really liked that new AI feature that they're going to release. That's still looking pretty solid. The FANG index finally broke out of this sideways trend, and it looks like we have an all-time high with the FANG index on a closing basis. We're really close to this previous one. We might be just a little bit below that. Financial sector continues to look positive and is in an uptrend. We're watching this staples to tech ratio. It came down. We want to see that continue to go down if we're going to turn more positive on the tech sector. The dollar ended up closing, even though in after hours it's up slightly. And looking at the S&P against a world index, the short-term relationship continues to be strong. But when you look at the longer-term relationship, they're just friends. Okay, staples still. They were down a little bit, but they still have been in a solid uptrend going back into 2023. We want to see this continue to decline if we're going to not be as worried about why are staples doing so well. Utilities also were up again and in a pretty solid uptrend here on the daily chart. Total U.S. stock ETF was up over 0.5%, looking solid, suggesting broad market participation. We were down with the 10-year yield. We were up with the 10-year based on price. We've been able to reclaim the 50-day moving average. And looking at some of our ratios between the tech sector and 3 to 7 year bonds, we're coming up a little further out of the rainbow. When we look at the Qs, the bonds, also coming up out of the rainbow. The S&P 1500 to shorter term bonds coming up out of the rainbow. And another broad market measure to further out bonds also coming up out of the rainbow. And I'm focusing more on the positive things for right now. I have a whole list of these charts, and I usually show them over the weekend. But if they're looking positive, I'm bringing them out in the daily videos. And this is still looking better. This ratio going down is positive for stocks. This ratio going down is also positive for stocks. We want to see it continue to decline, even though it's still in a longer-term uptrend. Same thing with this chart. We want to see this continue to decline. We want to actually drop down below the rainbow, but it did decline a little bit on Tuesday. And we're still looking like the market is anticipating a soft landing. We're going a little bit further up out of the rainbow. And when we look at tips, shorter term, Treasury inflation protected securities. When the market's worried about inflation, that's when tips outperform. When the market's not worried about inflation, like we saw this real solid move down back in October and into November, that's when stocks really took off. So we want to see this continue to drop. And the Eurozone, just to keep an eye on what's going there. The European stocks are still looking solid when compared to 3 to 7 year American bonds. But we're not seeing much improvement here with our growth to value ratios. Nothing much with the Qs to S&P. Discretionary to S&P is still declining. We're right on the moving average with large cap growth versus large cap value. So the large caps, the mid caps are actually declining, and the small caps are still declining. So we're not seeing a real shift in that regard. This is just barely starting to get extreme positive. This is the 10-day average of the S&P 500 highs minus the lows. We had come down and actually dropped below 50, and we've just been inching our way higher. This is a little bit longer of an indicator. It's not a long-term indicator. It's kind of a long intermediate term indicator, because this thing, it takes something for this to really move, and it picks up on what the trend is actually happening here. We're still positive with the 19-day advanced decline ratio based on price and volume. We're also looking positive with our 5-period moving average of the highs minus the lows across the broad market. This is still a concern. We're going down with the S&P to utilities ratio. We want to see this turn and go back up. And we're down just a little bit with our staples to S&P 500 ratio, but we want this to decline to turn more positive for the S&P. So what's our outlook for Wednesday? We're still positive, and we still have to put a question mark here. Yeah, we're extreme positive. That part's a fact. Whether that's a good thing or a bad thing, that's the question mark part. We will get the MBA mortgage applications index, and the huge report is going to be CPI and retail sales. Oh boy. And then the New York Fed Empire State Manufacturing, business inventories, the NAHB housing market index. And so there's quite a list. And then we want to just keep an eye on all the crazy things going on in the world in case they have an impact on the market. So on Thursday, we're going to get industrial production and capacity utilization. The market's really been paying attention to jobless claims and existing claims lately, so that could be rather influential. And then on Friday, we're going to get the leading economic index. And so here is the big block for Wednesday's session. Probably one of the more important trading days than what we've seen in quite a while. Let's just hope it actually sheds some light on the situation. Seasonality, we are positive with the Dow, neutral to positive with the S&P, neutral to negative with the NASDAQ. So, hey, take that. We get everything possible. And we do see a little bit of positive seasonality during an election year. That's the green dashed line, and at least one more day of positive seasonality according to this chart. But Wednesday tends to be the most negative day of the week. Now, it's down with 27.5% of the time. At least is that the return, annualized returns. But that means there are some up days as well. So there can always be exceptions, or it could go into what's already happened. And then Tom Bowley still has this in this negative part of May, according to his research. The warning signs, the Swenlin training oscillator, it's still positive, but we're still rolling over. We're turning back up a little bit, but we're declining as the market's going up. So we want to be aware of that. And then the mass index. And if you take it in the context, that would be more negative because we triggered that signal when we were going up. And then we're going to see, do we make a new all-time high with the S&P with staples and utilities just screaming to the upside too? That's usually not what happens when you're making all-time highs. And then the long-term ratios, they need to be watched. I'm probably going to take this off and shove those charts over in the weekly videos because they're longer term and they take a long time to develop. I've just been showing them lately because they're newer charts. Positive signs, we have a long list here. So just pause this and look at it where our indicators are looking positive pretty much across the board. Now we're having the NASDAQ 100 starting to show some improvement as well. So our conclusion, we're positive, but are we becoming extreme positive in a good way or in a bad way? We are extreme, but positive in the short and intermediate term. And in the long term, you could say we're extreme positive because we've been above those longer term moving averages for a long time, but they've been that way for so long. So we're just flat out positive there. Thank you. I really hope you found this helpful. Please feel free to send me an email if you want to discuss the idea of locking down these videos. And and what I do with these is if I don't hear anything, I'm saying, okay, people are okay with that. So if I do hear from you and it's not positive, that's okay. I want to hear feedback in those different areas. So have a great day, and I will talk to you in the next video.